All right, good afternoon. We would like to welcome you to our today's workshop about incentive schemes. We are happy to share some tax and legal insights in this 45 minutes for some reasons. All right, I'm Jonas Bühlmann. I'm a tax partner at Wenger Vieli. I mainly focus on tax topics around startups, venture capital, and M&A deals, and therefore have the pleasure to work with startup from the beginning until an exit. Happy to have that workshop with you, Dario.
Hello everyone, my name is Dario. I'm an associate with Wenger Vieli, part of the startup desk of Wenger Vieli as well, so mainly working with startups, especially in the corporate part of startups, so everything from incorporation, employee incentive schemes to financing rounds and the legal aspects of an exit, for example.
Maybe also a few words to our firm. Wenger Vieli is a mid-sized law firm. We are located in Zurich and Zug. We do more than 50 financing rounds per year. On the slide, we have like 15 exits per year. I think that's a number from the COVID time. I think this year we had already more than 15 exits. We focus on an entrepreneurial mindset. We are a one-stop shop for VCs, for founders, for startups, and therefore also have a strong network in the VC ecosystem. Employees, that's a wonderful summary. Employees are companies' greatest asset. They are your competitive advantage. You want to attract and retain the best. Make them feel that they are an integral part of the company's mission. Could be a statement, and the solution to reach that is very simple. Give them shares, make them to participate in the company. Unfortunately, the implementation of such an employee participation is not that easy, and that's the reason why we are here today. We would like to start with some legal aspects led by Dario. I will continue with some tax aspects, and at the end we will also share some ideas how shares could be allocated between founders, investors, and employees. Now, happy to give over to Dario.
Thank you very much, Jonas. So, starting with the legal aspects of such employee incentive plans. First of all, why should you care? This was already a bit summarized by the statement before. First of all, as startups, usually you're not in a position to pay the best and the highest salaries because just the money is not there. So a way to still make sure that you can attract and retain the talents that you need in your startups is to participate them in the company and to have them as shareholders or as phantom stock option holders, basically. The second point is if you are not bootstrapped and have investors, your investors will want you to implement incentive schemes for employees at some point as well. And the last point is really it really aligns the interests of the employees with the interests of the company if they know that the work that they do day in, day out actually also lands again in their pocket in the end if the company has a successful exit or has dividends to distribute. When should you care? As I said, your investors at some point will ask you to implement an incentive scheme if you haven't done before. With the incorporation, you don't really need to already have an employee incentive plan in place. However, it can be helpful already back then to actually really hire the talents that you need. So if you want to hire your first employees, they might want to have the possibility to participate in the company economically as well. So it can help in the incorporation phase as well. What's definitely helpful here, that's a practical tip on this side, is to already make sure that you have a conditional capital when you incorporate the company in about the size of a future initial pool that you want to have. The reason for that is with the incorporation, you anyways have to have articles of association. And if they already include a conditional capital, you're all set for the future for participating employees with such a conditional capital. I'll go into details a bit later. And if you don't have that and you want to actually issue actual shares or options to employees, then you will have to amend your articles of association later onwards. This requires a notary with notarization fees. You have to register with the commercial register. So this is additional costs that you will incur by doing that. So if you're not yet incorporated or you're in the incorporation process, small tip, put in a conditional capital already now. This can be really helpful down the line. At the latest, usually with the closing of your pre-seed, seed, your first financing round, investors will ask that you set up an employee incentive plan, at least post-closing. And for Series A, B rounds and in growth phases, it's normal that you already have an established plan. In the growth phase, usually you're not letting everyone participate in those plans anymore, but because there's just a few shares options left, and you really make sure that your management and the key employees can still benefit from such a plan and be joined in the company. How do you structure incentive plans? So from a legal perspective, you have two big options. So the first is the employees are actual shareholders or can become actual shareholders of the company with the respective rights. Or you go for the virtual track, the virtual shares or the phantom stock options where the employees are not actually becoming shareholders of the company. So with the virtual shares, they just have a contractual relationship with the company, and the company promises the employees a certain payout in certain events. And this payout is measured in the payout that the common shareholder gets in the company. So they're treated as if they are shareholders from a financial perspective, but actually they are not shareholders. You have also some other options. You have the options to actually issue shares, right, on the right, on your left side of the presentation. So the employees can become actually shareholders with the transfer of shares. Can either be share transfers from a founder, from leaving employees, or from the company if the company has shares. The other option, however, we see this very rarely in practice implemented, are participation certificates. So this is a stock option class that does not, where the employees do not have voting rights and just participate financially. This is possible to do. However, usually there's also downsides a bit because they have to be treated similarly to shareholders. They have to be invited, and their rights cannot be restricted as more than the shareholders. And it makes it a bit more complicated to manage the company because you then have two classes of shares, kind of, right? You have the actual shares, and then you have these participation certificates. The final option, which we see implemented in practice most often, if the company goes with actual shares, is the options. So that an employee stock option plan is implemented where the participants of that plan are awarded options that vest over time, and then the vested options can then be exercised and turned into actual shares if the conditions are fulfilled by the employees. On the virtual shares, just a note, right, as I said, this is just a cash event in case of an exit, for example, or a dividend if that's chosen. And there is a tax downside with that. It's really the PESOP, a virtual stock option plan. This is treated as full salary in the case of a payout. So it's like a bonus, basically. Maybe, again, on how you structure it with here, again, these four most likely scenarios with the shares, with the participant certificates, with the ESOPs. The PESOPs, here you can see a bit the distinctions that we made, right? First of all, the shareholder structure is different. The dilution is pretty much similar. The funding is different. The accounting complexity and costs are very high. So as you can see, with a PESOP, the complexity we put in as medium compared to high. I will go a bit further into that. The reason for that is if you have an ESOP with actual shares implemented, it's very important that the company has a very good management of that ESOP plan, and that the company knows which employees have exercised shares, which employees do have shares, which employees do have options, that if an employee leaves the company and has to return shares, that these shares are actually taken back to the company, right? And if this is not done, and you're in an exit procedure, you think you have done it correctly, but maybe there is no wet ink signature on this assignment declaration, then the buyers will ask you in the exit to go back to that employee and to get this signature in wet ink, which I can tell you from experience, if you have to do that, is really annoying, and you can just hope that you had not a falling out with that employee and that this employee still likes you and is willing to, 5 years after employment, provide a vetting signature on some documents the lawyers want him to sign. Of course, so we have also seen in practice that then these employees realize that they have a bit of a bargaining power and we're only willing to give this signature for money, basically, in return, right? Which is suboptimal. So really, so you have ongoing costs with actual shares or with an ESOP plan or also with participation certificates. Really make sure that these shares are transferred back to the company if they need to, and that such share transfers back are done correctly. Also with an ESOP specifically, you have yearly costs, more or less, because yearly you have to register with the commercial registry the exercises of the options in the preceding year. So if you have an employee that has 100 options that he exercised and turned into shares, this just happens without you having to do a formal capital increase, but by Swiss corporate law, you have to yearly then go to the notary and go to an auditor that confirms that these stock options were actually issued. So this is also a cost. With the PESOP, the administration cost is a bit less complicated throughout the process because it's just a contractual claim that the employee gets. However, we can tell you from experience, if you then come to an exit, if you have PESOPs, it gets much more complicated at the time of an exit because then these PESOPs have to actually to be settled, right? And this can be quite complex depending a bit on how much variations of these PESOPs that the company did. We have had in the past some examples of companies that had different variations, maybe like 11 base cases of different scenarios, which then also deviated a bit further. If you then have to calculate how much social security you have to pay on that, if you have to calculate how much the payout actually is, because the buyer will want to discount that from the share price, from the purchase price, it gets really complicated really fast and expensive in the exit, whereas with an ESOP, it's pretty straightforward, you know, or hopefully know at that point who actually is the shareholder of the company, and everyone sells the shares to the buyer and they get the respective payout. Maybe just to shortly touch upon the key terms of an ESOP or PESOP as well. So with an ESOP, you have, as I said, rights and obligations of a shareholder. So they are shareholders of the company with the respective rights. So they have information rights as granted by the law. So they can see the yearly financial statements, for example, and have to approve that in the shareholders' meeting. They have to be invited to the shareholders' meetings. And with a PESOP, you don't have that because they're not shareholders of the company, basically. What's really something that's a standard term or that we highly recommend to include is the pooling of the employee shareholders. So that, for example, one of the founders and one of the board members appointed as pooling shareholders that then basically is a representative for all employee shareholders and can sign amendments to the shareholders agreement for them, that can vote for them in the shareholders meeting yearly, so that the company does not really have to run to every employee and to get a POA for every closing and every future financing round, but that rather it's sufficient that if an email is sent out to everyone can vote, and then the majority decision is what the pool representative then has to act based on, basically. With the vesting schedule and the termination, I'll go to the next slide. Usually what we have is vesting over time, as I mentioned, so the employees do not get all the shares immediately with the grant, but they have to earn the shares over multiple years. The standard vesting that we see is between 2 and 4 years. I would say most common is actually 4 years with a 1-year cliff, which means that the employee has to work and be employed by the company for 1 year, and only then the employee gets 25%, and thereafter there's usually a monthly, bi-monthly or quarterly vesting of the remaining shares over the remaining 3 years then. What we see sometimes is the possibility of an early exercise, so that the employee can exercise the options a bit more early and actually get the shares earlier while the vesting is still ongoing. This, from a legal perspective, of course, is possible. As Jonas will probably tell you later on, from a tax perspective, for the employee, it's very beneficial. From a legal perspective, it means that these employees become shareholders earlier onwards. So if they still leave during this vesting period, you have, again, to make sure that from a legal perspective, you then buy back the respective shares so you can redistribute it to the company. And here, if they're actually shareholders, they have all the shares immediately. So there's probably, if the employee leaves then after 2 years, for example, then after these 2 years, the employee leaves the company, so 2 years worth of shares are not vested yet. The company definitely has to buy them back or get them back for free, basically, from the employee. And there, again, the vetting signature problematic comes in, that you have to do this correctly, and if you don't, then you'll probably have more problems later on. What's also a typical term is the acceleration. And from time to time, this means that if, for example, the vesting takes 4 years for the employee, but the company is sold after 2 years or after 3 years, then with the acceleration, it's possible for the employee that the employee gets still the payout as if it's after these 4 years, basically. So the company kind of grants the employee this 1 additional year or 2 additional years of vesting and treats him as if he would have been working with the company for 4 years. There's a differentiation between single and double trigger. Single trigger means the exit is enough, and double trigger is meant as a way of an incentive. Then, for example, then there's a second trigger, so the employee only gets the full vesting if the employee stays on for the company, for example, for 1 or 2 years after the exit as well, which especially with key managers can be really helpful to incentivize them already from a seller perspective, that they will remain with the buyer in the company and support the company also after the exit, also in order then to get a bit this payout and these benefits. And finally, with the termination, you have the differentiation between good and bad leaver, typically. Sometimes also it's something in between called a gray leaver. A bad leaver is an employee, usually that, for example, steals money in the company and is then terminated with an important reason in accordance with the employment law, so without a notice period. And of course, such an employee needs to return all shares regardless of vested or unvested. You probably don't want to grant this employee an additional payout on top of the salary, right? And then in turn, you have a good leaver. That's then typically an employee that is either terminated by the company, for example, for economical reasons, right? And by that, of course, then gets the full amount of vested shares. Perfect. That's a real short summary on the key legal terms. And I'll hand over to Jonas now to explain a bit the tax concepts behind that.
Thank you, Dario. I know taxes is not the most interesting part in life, but it's a very important part if it comes to employee participation. It's a topic which is mainly tax-driven. And the very general rule is if an employee gets some sort of money, even in cash, in shares, in whatever, the fair market value of that is taxable. Taxable means income tax and social security contributions. If it comes to shares, the difficulty obviously is how we're going to value these shares. Could be these options, the PSOP. I have to start with some key concepts. We first start with shares, then move on to options, and finally I close with PSOPs. And in the second part, we will have a look on certain key topics. But the general taxation concept of shares is basically pretty simple. The tax authority says we have 2 times when we tax the shares. Once when you acquire them, and second when you sell them. What we do a valuation. Normally there's no fair market value available of a share. So the tax authorities have their own tax valuation, meaning practitioner's method, or in German Praktikermethode, which is 2 times the earnings value and 1 times the substance value. We take the average of that. And for a normal startup, the capitalized earnings is 0. So meaning the substance value is always the minimum value of a share, which is actually not that substantial. If the equity is negative, then the tax authorities apply the nominal value. Meaning in consequence, if an employee gets shares for free, at least the nominal value must be taxed at the time of acquisition. We also put a note at the end here of the slide that each company is free to define its own valuation formula. That can be quite beneficial in terms of tax planning, meaning you define a formula. Very often used are multiples, earnings multiple, EBIT multiple, EBITDA, something like that. But you need a tax ruling, you need an upfront tax ruling to agree on such a formula with the tax authorities. What important is you must factor in that formula some sort of a profit component, and it must be based on actual financials. So it's not possible to base a valuation formula based on budget numbers, for example. So a question we often have is you have a valuation from a financing round, and that would, to be honest, indicate some sort of a value which could also be used for tax purposes. What luckily the tax authorities do, they say we will exclude that valuation entirely for tax purposes as long as the company is qualifying as startup for tax purposes. And that's the definition here with the red bullets. It's basically pretty simple. It must be a technology-based business model which is scalable. The company must be in the build-up phase. That's an important part, for example, also in the canton of Zurich. And the company must be in a loss-making situation, mainly driven by expenses. It's okay if there are some earnings, but these must be on a lower level, really in the build-up phase. For, let's say, a startup, maybe incorporated the last 5 years, that's not an issue we are discussing with the tax authorities. That's mostly clear. Maybe for startups which are in a different stage, that can become an issue indeed, but not for early stage startups. So here we made an example in numbers, basically pretty simple. I would say important for startups is really the graph we see on the right corner. It's mostly substance value, that's a tax valuation, or at least a nominal value. And here we have a picture how that could look like. In that example, the employee is paying the purchase price of 1 Swiss franc per share. Could be, for example, the nominal value that we could do the capital increase. The tax valuation is 9 Swiss francs, meaning the employee has 8 Swiss francs income tax and also social security contribution. Like same taxation as a salary. Important here is to note that the startup, the employer company, also burdens a part of the social security with the employer part. The employer must also disclose the taxable benefit on the salary statement. So employee and employer have some sort of same interests if it comes to taxation of employee shares. That's it for the acquisition. When a sale happens of employee shares, the tax authority do the same. They again calculate the tax valuation, and all which is above the tax valuation here is again subject to taxation. Tax valuation significantly, tax valuation significantly increased to 30. The employee can sell it for 70. 40 is taxable income per share. What we see in this example, the increase of the tax valuation is always tax-free from day one. To be honest, the example we have made that to show exactly this effect. In practice, this often does not happen in that way, but that would exactly be the reason that you decide to do your own valuation formula. With the standard tax valuation, it's difficult to have an increase. And if you see some potential, for example, in the EBIT, you could define from the beginning an EBIT tax valuation formula that you can exactly generate such tax-free capital gain just with the formula. So that's something which is often forget, but which has basically high potential. Even a higher potential is like what we see on the right-hand side. If employee shares are held for 5 years, you can then sell them tax-free, meaning on the right-hand side, there's no taxation. There's unfortunately one major exclusion of that rule, which is not applied by all cantons. It's mainly applied by Zurich, Schwyz, and some other cantons. They say you must sell the employee shares to a third party. Third party meaning not an existing shareholder and not the company. And that's basically an exit transaction. So if you hold it for 5 years, there's an exit transaction, then it's tax-free. That's the main benefit. That's the main reason that you do employee shares from a tax perspective. But if an employee holds the shares for 6 years, he or she has to leave the company, sell the shares back to the company, to the founders. In Zurich, that will not be tax-free. And also what we see, other cantons will align their tax practice more to Zurich. There are more cantons to mention in that category, unfortunately. So selling shares to a related party becomes difficult after 5 years and having a tax-free capital gain.
Small question.
Yeah.
Isn't there also a possibility of reduction of the taxable amount at the acquisition phase when they are blocked for a certain period of time?
Yeah, exactly. Thank you for that question. We have not that in our slides because we had to limit it. We could speak here the entire afternoon, but that's true. If you have a legal blocking period on the shares, you will reduce more or less 5% per blocking year the taxable income. But to be transparent, we do that very rare in practice because a very important reason, if you agree on a 10-year blocking period, the employee, or we could also say 5, that's maybe more realistic, the employee will leave and have to sell the shares after 3 years. 2 years of the blocking period remains. The tax authority do then the valuation, calculate again the discount on the 2 years, and if the tax valuation is then higher, you have again a taxable income, which is actually higher than the original discount. And given that it's sometimes difficult to do planning of life and of your business life, that simply can also end up not in a good fallback position, but that's an option, yeah, indeed. Let's move on to ESOP. ESOP is pretty simple. If an employee gets an option, which is obviously not listed at the stock exchange, then nothing happens for tax purposes. Once the option is exercised, the employee is buying the share, then we have again the same taxation as for employee shares. We do the formula, calculation, blah, blah, blah. So actually nothing new. Important here is the last one. The 5-year holding period only starts when the employee is acquiring the share. Meaning if he or she is acquiring the option, having a vesting on the option of 4 years, acquiring then the shares, it took 9 years until we have the potential for the tax-free capital gain. And that's exactly the reason to make a reverse vesting instead of a vesting. We see that also later on a picture. That's basically the same. You already know, exactly same. And for the PSOP, it's also the PSOP, I would say, is the easiest one from a tax perspective. It's pretty simple. When the employee gets cash, it's taxable as a bonus. Really, when there's a cash flow, we have taxes. So much easier to calculate, no dry income as for employee shares. But on the other hand, it's not possible to generate a tax-free capital gain. If we, for example, have a key employee, she or he is maybe in the company from the start, have 5% as PSOP, there is a good exit transaction, he or she gets 2 million Swiss francs, then for sure the maximum income tax rate applies. In many cantons, it's roughly 40%. We have, in addition, the social security, so we speak about taxation of 50%. And then the employee will not get 2 million, he or she will just get 1 million. So that's a little bit the trade-off. We also have summarized here. From a tax perspective, that's really the key question. We have the PSOP on the right-hand side with these advantages and disadvantages, and the shares on the left-hand side, where we have potential for a beneficial taxation, for a tax-free capital gain. On the other hand, we have the tax implications when employees acquire the shares. We have dry income, they have taxes, but they will not receive any cash. And that can become an issue in some cases in practice. And therefore, that's really the trade-off. Besides the legal aspects, Darius mentioned, also taking the complexity into consideration between the plans, also from a tax perspective.
I've heard about VSOPs as well.
That's the same as the
So
TSOP.
ESOP and VSOP are the
Yeah,
same.
exactly.
Okay.
Exactly.
Thank you.
Now, I would to point out some special topics, some selected special topic. Let's say, as I said, we could add there much more. The most important exemption of all the rules I have summarized are the so-called founder shares. Shares which are subscribed within the foundation are not considered as employee shares and can be sold tax-free, but only these shares. If a founder subscribes 100,000 shares, have some additional employees which will join the company, some investors, and at one point later in time the founders decide to subscribe new shares, then these are employee shares, even if these persons are the founders. Late co-founder is something we see very often in practice for different reasons. Sometimes people have a non-competition agreement, cannot subscribe shares. Sometimes two founders start and will extend the team with two new people. There are limited options that also late co-founders could have founder shares. Very important is that there is an agreement at the time of the foundation when and how these late co-founders will subscribe the shares. And it's strictly limited to 12 months. Classical reason is really you have a non-competition agreement, you do an agreement at the time of the foundation that once this is lapsed after 6 months, he or she will subscribe 10% of the shares of the company, something like that. Tax authorities themselves recommend a tax ruling for that. We, to be honest, as well. But it will work. It will work. There's also more or less something similar called the dynamic equity split, where you may have a team subscribing the shares 50-50 at the time of foundation, but they agree, and that's also important that you have a written agreement at the time of foundation. They agree that they may reallocate the shares within the first 12 months. Could be based on leads. How many clients you bring to our startup, based thereon, we may reallocate. If you then have a ruling, you can, within the 12 months, reallocate that. And in the example on the right-hand side, for founder B, the 60% are still founder shares. So that's topics we have very often in practice, I must say. That's basically the more detailed version about the vesting versus revesting we already talked about. So from a tax perspective, we really recommend to reverse vesting. It's more a little bit than the question whether you would like to have the people from day one as shareholder, or whether you would like to have some sort of a period in between with options where they have less insights, or whether you prefer the legal aspect that's simply easier to cancel an option compared to request again the share. But from a tax perspective, my decision would be clear. Also, an important exemption is if employees are acquiring shares at fair market value, we call them investor shares. These are not employee shares, then can be sold tax-free. The difficulty here is what is a fair market value. That's also something we very often discuss with tax authorities. They have qualified thresholds. So for most tax authorities say there must be a share subscription at 10% of the share cap. You must subscribe to shares within the next 6 months. You must not have any leaver clauses on them and the exact same conditions as other investors, and then we consider that as a fair market value. So seems reasonable. In practice, give us mostly a headache, to be honest. So to sum up with some key takeaways, please keep in mind that with taxes there are compliance obligations. A salary certificate is an official deed, so that's something important legally, let's say. The employer company must disclose that on the salary statement, on that deed, and also leave the social security contributions. Please keep in mind the vesting versus the revesting. Please keep in mind that taxes are always some sort of a driving factor of the valuation. So if there are taxes, the valuation is simply decreasing. So it makes much more fun if you have if you have an employee incentive plan which is tax efficient. Please keep in mind the founder shares, those are the most valuable shares. If you have founder shares, you give them to an employee, the employee leaves, you buy back these shares. These are not founder shares anymore, these are then employee shares. And you as founder could also be faced with tax and social security implications on these shares. And please keep in mind the exit, at least from a tax perspective, starts very, very early. To be very honest, it actually starts before you set up the company, given the topic about founder and late co-founder shares, and this is an ongoing process. Now I'd like to hand over to Dario for some last thoughts on the allocation of shares.
Thank you, Jonas. Yes, but you also maybe ask yourself is how much do you grant in part of percentages of the shares, right? First of all, there's no perfect number. However, as a rule of thumb, at the exit, so in the company is being exited, between 15 and 25% of the shares should be for non-founder employees. And the remaining part should be split between the founders and the investors. That split depends a bit on the valuations between the founders and investors, depends a bit on the field you're in, right? In biotech and medical startups, usually the investors have a bigger share than compared to a normal tech startup where the founders still have usually a high percentage. Still, also to consider this, of course, is with the employee shares in an industry. If you're in tech industry, the employees usually have higher percentage of shares at the exit, versus in other fields this is a bit less. Also important to consider when you grant shares to an employee is the skill set of the employees. You want to provide to key management, key employees, a higher percentage of shares, and you still want to have, especially early on, room for further allocations down the line, so that you really can incentivize the relevant employees for your company and to really align the interests of them with the company's interests to make sure that they perform for the company and generate value. Possible allocation guidelines a bit on the type of allocations, right? What you typically see is that a CTO has between 1% and 5%. Key developer sales people have usually between 1% and 2%, again, at the time of the exit, and other employees have then between 0.5 and 1.5 percentages. If, for example, the CFO is also in here, that's usually then also between 1% and 5%, so similar to the CTO, if the CFO is important to the company's business because the founders are maybe more on the tech side, for example. By seniority, what you usually see is that around the first 10 to 20 employees, that they take up about 10% of the shares at the exit. The next 20 employees have another 5%, and then the next 50 employees have the remaining 5%, which is also an allocation.
So when you say CTO, CFO, you mean they are not the founders?
Yes.
The founders can be also CTO, CFO, CEO.
Of course.
Yeah.
Of course, yeah, that's of course possible. Yes, here it's if an employee in a CTO function, yeah, exactly. Sometimes it depends a bit. We also see that in practice, the founders are receiving grants under an ESOP or PESOP plan as well. However, from a tax perspective, of course, and this is employee shares, which has taxable consequences. We see this often if, for example, the valuations of a round is not that great and the founders lose or have a high dilution, then that dilution is then a bit mitigated by the investors, usually by then providing additional shares to the founder team that's still actively working in the company by way of an ESOP, for example. That's we see from time to time. So it's possible, yes, but usually if the founders have still a good percentage, it makes more sense to participate the actual employees, right, to align their interests as well. But it's theoretically possible. Going shortly back to what I told you in the initial 15 minutes, in case you forgot already a bit what this presentation started out with, the big picture, legal and negotiation pitfalls. First point, as I mentioned before, ensure that the clawback, so the buyback of the options and shares is done, and the company is very flexible in doing so. But what you see from time to time in practice is that there's limitations in the time when the company is allowed to buy back, for example, vested shares. It's a bit a pity if you realize 2 years after an exit, 2 years after employee left, that this employee still has shares, and you in the ESOP wrote 3 months, and now you cannot get those shares back anymore, right? So their flexibility for the company is key. Also key is really that you have a lean cap table, right? And that the employees are really pooled together effectively, so that you don't, in an exit, or generally don't have to run after 70 employees and get their signatures to get the financing done that the company needs now, right? Or it's bankrupt the next day. This is a bit the situation you want to avoid. So here it's really important that an effective management of the shareholders, of the employee shareholders, is in place. Then, you have to, again, keep in mind with the accounting, how to account different plans. ESOP usually is not accounted, right? Just a note on the salary certificates that an ESOP exists and that their grants are being made. Same with the PESOP. But in an exit scenario, then the PESOPs are actually accounted as debts in the company. And then again, what to keep in mind are also the costs and complexity questions. As I said, an ESOP is more complex to manage throughout the lifespan of the company, and whereas the PESOP is much easier to manage because it's contractual obligations. And then in an exit, the complexity turns a bit, right? The PESOP is much more complex in an exit scenario, and an ESOP is much easier to handle, provided that it was done correctly in the past. Otherwise, the complexity is also, again, very high. And then on the cost side, with an ESOP, you have the yearly costs of the management and also of the notarization, of the confirmation of the exercises of the options throughout the year. Whereas with a PESOP, you do not have any yearly costs. However, you have then usually much higher costs in an exit scenario with a PESOP due to the settlement of these PESOP plans and options granted under those. Now I think that maybe the next slide. One more. Yeah, no, one back, sorry. Here you see our startup packages that we have at Wenger Vieli. We also have an employee participation plan one for 2,500 Swiss francs. And as a workshop special offer, we offer you guys a free 30 minutes call to discuss in particular a setup of your potential employee incentive plan. If anyone wants the slide deck, you can also send us an email, and we're happy to share this with you guys. Our email addresses will be on the next 2 slides. But first, any questions on tax or legal aspects?
Yeah, I have So, hi, thank you for the presentation. First of all, it was super interesting. We're in the process of doing the ESOP plan as well for our employees. I had a question more personal to applying to myself, is that we started the company 4 years ago, and during the seed round that we just closed now, the investors were very worried that we would leave the company with our shares, and they asked that we revest our shares, and apparently it's something that is very common. At every stage of financing round, they asked to revest at least part of the shares. Now, in terms of the taxation, when you said that the shares have to be owned by more than 5 years in order to be tax-free on capital gains, does that mean that I lost half of my valuation on my shares, or I will pay half of in case of an exit next year, for example? Or what does that mean?
No. If you have founder shares, meaning you have subscribed them at the time of foundation, they remain founder shares, even if you agreed on leaver conditions with investors.
Okay.
So that's very common. We had that a few times get confirmed by the tax authorities. Also, let's call it by the strict accountants, for example, like Zurich, they are fine with that. So that's all right.
Okay. And I live in Vaud, Geneva, these kind of things. It's fine as well, or
I have not tested it, to
I
be honest,
have to go
with,
to
with
Schaffhausen.
Geneva, but I would be very surprised if they will not accept that.
okay, cool. Thank you.
Can you run a technology company with only founders, no employees, subcontracting to another company that's paying people that are doing the subcontracting company is effectively giving a salary to the founders that are doing employee work as non-employees? So everybody functioning as a founder, they're not an employee, but a subcontractor is paid to do a lot of the work that a normal employee would have done, and effectively you've got a company with no employees. Is that ever done? Is that too confusing?
For the setup, so you have a subcontractor that basically does all the work, development, for example, of the software or what the product that you're doing, and on basically the company, the operational company level, you just have the founders that are working for the company as well, or that are mainly in a board capacity, working a couple of hours a week managing the company, and the rest is done with the subcontractor.
Well, they're actually working for the project of the company effectively through the subcontractor.
Yeah.
So you're not an employee of that company, you're an employee of the subcontractor.
Yeah.
Do companies go with no employees here?
To be honest, we see that quite often with employer of records. You have some employees, for example, in Germany, they are engaged by an employer of record, and you would like to give them shares, you would like to give them PSOPs. To be honest, if you ask the Swiss tax authorities, they have quite difficulties how they would like to look on these structures, but finally, it's substance over form. So if they are considered as an employee, meaning they are integrated in the organization and treated as an employee, then you have the exact same topic. You would also look on employee shares then. But it's more a case-by-case study then, but it's substance over form in general. But for some reasons, that's something we have more, and we have more often now, especially with employer of records. So it's, I would say, always become the standard case, that also an employee has some shares which is not officially employed by the company.
And on the legal side, it's possible to have no employees.
Is it a red flag for tax authorities?
No, that's all right. I mean, it's simply how companies are organized nowadays.
Okay.
Just a question on the founder shares, to make sure I understand correctly. So the 5-year term doesn't apply to founder shares, right?
Yeah, correct.
So if an exit happened after 1 year, it's tax-free capital gain.
Yeah, exactly.
Okay. And then for the different participation plans, what is the most common one that you see in Switzerland for early stage startups?
It's really a case-by-case choice. I would say in the past years, I've seen mostly split, actually, most common, split between ESOP and PESOP, that companies incorporated an ESOP, so actual shares or options, usually with reverse vesting for the first key employees, which can usually, if they don't leave the company at some point, become kind of your management or important employees, that they actually received an ESOP so that they have the possibility for a tax-free capital gain. Then later on, PSOP was implemented when there was anyways a bit more the outlook, okay, an exit will probably happen in the next 5 years or might happen in the next 5 years, where then tax-wise it doesn't make a huge difference anymore between ESOP and PESOP. So we have seen this setup a lot as well, but it's really case by case. I would say it's about 50-50, otherwise split between ESOP and PESOP. I think I personally would also do a split, actually. First an ESOP to really provide my first employees this tax-free capital gain, and then later on implement the PESOP where it doesn't make a lot of differences anymore.
Yeah, and I think if when you see that there will be an exit within the next 5 years, then I would stop allocating shares, because they will be anyway not tax-free. Then you can also continue with a PSOP. Any additional questions? Yeah.
I've had at some point a situation where the options are not bound to better good leave, so they would always be cancelled if somebody leaves for whatever reason. How common is that? Because that's not at all useful, I think.
This is actually quite common as well. At least a bit in older plans, I would say this is very common, that if an employee leaves the company within the vesting, within the 4 years, that then the shares, that then this employee is considered as a bad leaver and loses all the shares, right? What you often see is that the employees lose the shares even when they are vested, or that the company buys them back at the fair market value, for example, or at a discount to the fair market value at the time where the employee leaves. So basically the employee then gets to participate in the increase of the fair market value throughout the employment phase, but then still has to return all the shares so that they can redistribute it to other employees. That's actually quite common, I would say.
I mean, in the case the company would actually exit the employees.
What do you mean? Sorry.
The company actually fires all the employees.
That then they're considered a bad leaver and lose all shares.
Yeah, that's stupid.
Okay.
I'm not surprised, but that's actually stupid.
Okay, that I haven't seen so far, I must say. Yeah, okay. I understood it the other way around, sorry. Yeah, no, this is not really common, I would say. I've never heard in founder or anyone bring this up, that this is something they would like to do. Apart, of course, this is for important reasons or for performance reasons, right? Then we see this, but if it's just for financial, the company has troubles with the next financing round and then has to terminate some employees, unfortunately. If then those employees also lose their shares, I would say that's a tricky situation. Yeah. Any other questions?
I actually have a question about founder shares at incorporation. So the taxation at that stage, if let's say a founder has 50%, incorporated an AG with 100K capital, what's the tax implication at that stage?
For founder shares, you do not have tax implications. So that's really an exemption. You can forget the entire topic about employee shares. There is no taxation.
So I have to declare that I have this number of shares that were granted because I have them as founder shares this year, and I have to put a value for them. I mean,
that's always difficult. The tax authorities, they value the shares on their own, but you have to declare something. What we normally recommend is simply declare the nominal value of the shares. Maybe you make the remark in brackets, nominal value. Put that on your Wertschriften- und Guthabenverzeichnis in the personal tax return, and then it's fine for you. If the tax authorities see a different value for wealth tax purposes, they will adjust that on their own.
I see some people leaving, so if you want to get the full slide deck, you can write us on these email addresses and we can send this to you guys. Any other questions in the meantime? I think we have plenty of time for one or two more. Needed. Otherwise, we'll probably be around here. We also have our booth downstairs, so if you have anything else, feel free to stop by.
All right, many thanks.